Hi, welcome back to Joe Blogs. In today's episode, I want to talk to you about what's happening in the Chinese economy. The latest trade figures have now been released, which show that exports in November 23 were up 0.5% year on year. And this is the first time that China have recorded positive growth in exports for 7 months. So at face value, that looks like good news. It looks like the Chinese economy is back on track. However, in today's video, I want to dive into the details as to how China have managed to achieve this. And one of the reasons that they've got there is by cutting their prices again year on year. So China is basically looking to reduce its sales price to increase the volume of its sales to achieve an overall growth in the total value. But the problem that Chinese companies are encountering is that the continued fall in sales price at a time when costs are rising everywhere else around the world means that the profit margins are consistently being squeezed for all of these companies, and there is now a very real chance that a lot of Chinese companies are operating at a loss. If you take your costs down to the bone but continue reducing your prices, there comes a tipping point when you're no longer making any profit. And obviously over the long term, that's not sustainable. If companies consistently post losses, then ultimately that leads to bankruptcy. So in today's video, I'll have a detailed look at what's been happening to exports. We'll dig down into the producer prices, the factory gate prices, to see what's been happening over the last few months in China. We'll then have a look at what's happening with imports, because China imports a lot of raw materials and components, which it then uses in the manufacturing process before it exports the final goods. So imports gives us a really good steer as to what's likely to happen to exports over the next few months. We'll then have a look at what's happening with inflation, because there are now major problems in the Chinese economy because prices are falling. So China's now experiencing deflation, which is something that we've seen in Japan over the last 20 years. And deflation has serious implications for the Chinese economy and Chinese companies. We'll then talk about what's been happening with the Chinese yuan, which has also been falling in value, which has an impact on imports and exports. And then finally today, I'll wrap up with my summary as to what I think is likely to happen in the Chinese economy over the course of the next 6 to 12 months. But before we get started on all of that, I'd like to say thank you so much to everybody that's supporting the channel. If you bought me a coffee or sent me a YouTube super thanks or signed up as a patron or a member or bought a ticket in the recent raffle for the little red dog, thank you so much. I genuinely appreciate your support. This chart shows the year-on-year movement in the value of China's exports over the last 12 months. And I think this chart is a good summary as to why the Chinese economy is currently in difficulty. Because China is entirely dependent upon exports. It's a manufacturing country. It makes lots of things which it sells to other countries around the world and earns money from doing that. And as you can see, in 9 out of the last 12 months, the year-on-year movement in China's exports has been negative. And if you look at the shape of this chart, you can see that there's been 2 downturns. At the end of 2022 and the start of 2023, the value of China's exports fell significantly. And that was attributed at the time to the fact that China was still imposing COVID-19 lockdowns on whole cities if it was finding 1 or 2 cases. Now, the lockdown restrictions were actually removed at the end of 2022, and the prospects for China looked bright at that time. And as you can see, the value of China's exports in March and April actually moved into positive territory. However, unfortunately, at the same time as that was happening, the global economy started to slow down. So demand for China's products started to weaken. And as a result of that, the value of China's exports moved into negative territory again in May 23. And by July 23, the year-on-year movement was over 14% negative. If we're now focusing on what's happened in November, you can see that year on year, the value of China's exports have actually increased by 0.5%. And this is the first time in the last 7 months that China has returned positive growth. Now, the return to positive growth actually surprised the markets. Everybody was expecting that November would come in at another negative figure. However, there are 2 things to be taken into account here. The first is that this is a year-on-year comparison. So we're comparing the 12 months to November 23 to what happened in the 12 months to November 2022. And the year-on-year movement in the 12 months to November 2022 was a reduction in value of 9%. So the figures that we're comparing against are a very low base. So the fact that China has achieved 0.5% growth at face value is good news. However, because the results for November 22 were so poor, the absolute level of trading here isn't that impressive. But the second factor, which is potentially more important in terms of the impact on China's economy, is the price that China has been achieving for the goods that it's exporting. This chart shows the movement in China's producer prices, which are also referred to as the factory gate prices, over the last 12 months. And what is evident from this chart is that in every single one of the last 12 months, China's producer prices have been falling. If you're a company that's selling a product, generally speaking, there are two ways to increase the sales of that product. The first is by marketing to promote the product, raise awareness, and hopefully achieve a higher level of sales. And the second is to cut your price to make it cheaper and therefore sell a higher volume. And what this producer price chart is showing is that over the last 12 months, China has been consistently cutting its prices to try to achieve an increase in total sales. If we quickly jump back to the year-on-year movement in the total value of China's export chart, you can see that in March 2023, the total value of China's exports increased by 11.3%. However, if we look at what was happening to producer prices in March 23, they actually reduced by 2.5%. So what that tells us is that the 11.3% growth in total exports was achieved by selling a much larger volume at a lower price. But when you start cutting your prices, it can result in a couple of problems. Firstly, your consumers get used to those lower prices, so it becomes difficult to be able to raise your prices again. And secondly, if you cut your prices too severely, you can saturate the market, and there may come a point where it becomes difficult to continue increasing your volume of sales. And if you look at what happened to the total value of China's exports in May, June and July, by July 23, the total value of China's exports was down year on year by 14.3%. And if we look at what was happening to producer prices over the same period, they were down 4.6% in May, 5.4% in June and 4.4% in July. So at that point, China had continued cutting its prices, but it was no longer achieving the objective of increasing the volume of sales. And so China became caught up in a vicious circle whereby it was cutting its prices and still not achieving an increase in total sales. And you can see that this problem has persisted in August, September and October, where China cut its prices by 3%, 2.5% and 2.6%, but that still had a negative impact on the total value of the sales. If we now focus in on what's happened in November, as we've discussed, the total value of China's exports increased year on year by 0.5%, but to achieve that, China had to cut its prices by 3%. So once again, what we're seeing here is China is discounting its products. It's reducing the price to try to increase the volume. So on an overall basis, the total value of China's exports have increased. However, as a result of the fact that Chinese companies are having to sell their products at a lower price, the profitability of those companies is falling, and there is even a potential that some of these companies are selling their products at a loss. This chart shows the year-on-year movement in the total value of China's imports over the last 12 months. And the reason that the level of imports is important is that China imports a lot of raw materials and components, which it then uses to manufacture products before it exports them. So what's happening with imports gives us a very strong steer as to what's likely to happen with exports over the next few months, because this is basically the forward ordering of all of those components. And once again, this chart evidences the problems that China's been experiencing, because in 10 out of the last 12 months, the total value of imports has been negative. And as we discussed earlier when we were talking about the exports chart, once again, you can see the two waves here. At the end of 2022, the Chinese economy was suffering problems as a result of the COVID lockdowns. The reversal of that trend in terms of imports only lasted for 1 month in February. And between March and September, the value of imports fell. Now, interestingly, the total value of exports increased by 3% in October, and that gave some commentators hope that things were starting to turn around in China. However, as you can see in November, the total value of China's imports fell by 0.6%, which means that year on year, China bought in less raw materials and indicates that it's likely that we will continue to see exports struggling over the next few months. This chart shows the year-on-year movement in the official rate of inflation in China. And what this shows is that in the last 5 months, China has only achieved a positive rate of inflation in 1 month, and that was 0.1% in August. Now, normally when we're discussing problems with inflation, we're talking about high rates, maybe 10% for the West or 280% for Venezuela. But the problem that China is now facing is deflation, the opposite of high rates of inflation, where prices are actually falling. And as we discussed earlier in the video, Chinese companies are actively cutting their prices at the moment to try to achieve higher volume of sales. But the problem with consistently cutting prices is that it can cause deflation in your home market. And whilst that might seem like a great idea if you're a consumer, if you're actually buying things, it isn't good news if you're a company, because the vast majority of companies work on the basis of increasing their prices. As a general rule, the cost of things increases year on year. If Chinese companies are having to buy in goods from overseas, then generally speaking, they will cost more today than they did this time last year because prices have been rising. But the problem that Chinese companies have is because they're needing to keep their volume sales high, they're cutting their prices. And as a result of that, their end price is lower year on year today than it was this time last year. So what that means is that if you've got rising costs and falling prices, then your profitability is definitely falling. And a lot of companies in China may very well be in the position where they've cut their prices to the point where they're making zero profit. And what that means in terms of employees is that it's very difficult to be able to offer anybody a pay rise, because if you haven't got any profit, it's difficult to justify paying people more, because all that's going to do is increase your losses further. And in the long term, this situation is entirely unsustainable, because if a company repeatedly posts losses, it may become insolvent and bankrupt. So deflation represents a serious risk to both the Chinese economy and Chinese companies. If this was happening all over the world, if every country was experiencing the same rate of deflation, then it wouldn't be a problem, because universally costs would be going down and therefore companies could afford to cut their prices. But the fact that this situation is currently isolated to China means that the Chinese companies are struggling right now, and if this persists for the next 3 to 6 months, we may well see many companies starting to become insolvent and going bankrupt. This chart shows the movement in the exchange rate between the US dollar and the Chinese yuan over the last 12 months. And what this shows is that this time last year, $1 US was trading for around 6.8 yuan. Today, it's trading for around 7.2, which means that over the last 12 months, the value of the yuan has fallen by around 6%. And the reason that I wanted to highlight this is that generally speaking, if the value of your currency is falling in the international markets, it should help with your exports, because relatively it means that your products become cheaper worldwide. If we take a very simplified example of a product that has a sales price of 6.8 Chinese yuan, this time last year that product would have been selling for $1 in the international markets. However, today, as a result of the fact that $1 is now trading for 7.2 yuan, that same product would be selling for 94 cents. So working on the assumption that a lower price will result in higher sales, this should be good news for Chinese exporters. However, if we quickly jump back to the exports chart, you can see that the value of Chinese exports has been negative in 9 out of the last 12 months. So China hasn't really benefited from the fall in the value of the yuan. And what this means is that despite the fall in the value of the currency and also the reduction in the factory prices that have been introduced by the Chinese companies, year-on-year growth in Chinese exports has still been down, and this really highlights the problems that Chinese companies are having right now. So what's the summary and conclusion today? Well, I wanted to post this video because the latest set of results that China have posted are really interesting. The 0.5% year-on-year growth in exports at face value looks like a good outcome. It looks like a good basis for China to finish 23 and go into 24 on a very strong note, because exports are the heartbeat of the Chinese economy. That's really what China depends upon. And if they're increasing, then you would think that that's going to be good news for the rest of 2024. But as we've discussed in today's video, the way that China have managed to achieve that overall increase in export value is by cutting prices again 3% year on year. So China is basically offering its products at a very low price to try to get the volume up in order to get the total value to increase. And that's what's been achieved in November. But the problem that poses for Chinese companies is that year on year, they're now selling their goods at a lower price than they were this time last year. And because costs are rising in virtually every other country in the world, China's import costs are going up at a time when their sales prices are coming down. And if you have a situation like that, all that means is that you're going to make less profit on the end sale. And as we discussed, there is a genuine possibility, given the level of price cutting that Chinese companies have been involved in over the last 12 months, that a lot of these businesses may now be selling the final product for less than the actual cost, which means that they're booking losses. And that is not a sustainable situation. And the problem with price cutting is now becoming evident in the wider Chinese economy. Over the last 5 months, China has only seen positive inflation in 1 month, and that was 0.1%, so virtually zero. And in the last 2 months, we have seen actual deflation. So prices on the shelves in China are now falling, which is good news for consumers, but really bad news for all of the companies that are selling those products, because they've got increasing costs at a time when their sales price is falling. So exactly the same situation as we've just talked about. So the walls are currently closing in on Chinese businesses, and this is going to be a very difficult situation for the Chinese authorities to solve. One of the reasons that the Chinese economy is in such a dire situation is because 25% of the economy is made up by property. And as we've talked about in lots of other videos, the Chinese property sector is currently on its knees as a result of the boom bust that it's followed over the last few years. And up until the last 6 months or so, that was the main problem that the Chinese authorities were facing. However, they've now got problems on a number of different fronts. And the issues that we're seeing with regards to Chinese trading businesses are partly a result of what's happening in the global economy. As the global economy slows down, consumers are buying less things, and therefore Chinese companies are selling less. And that's obviously something that's very difficult for the Chinese authorities to do anything about. You can't control global supply and demand. So what China have done to try to address the falling sales is reduce their prices. But there does come a point where even if you continue reducing your prices, you won't achieve increased sales. And that's the situation that Chinese companies are finding themselves in right now. And as the Chinese economy is now going into a spiral of deflation, that won't be sufficient to support those businesses. So there is a very real risk as we go into 2024 that some of these Chinese companies won't be able to survive without state support. So over the next 3 to 6 months, if we continue to see a slowdown in the global economy, which is likely, it's likely that the Chinese authorities will need to offer bailout facilities to a lot of these companies to enable them to survive. If they don't step in to support these businesses, then we could see a raft of bankruptcies starting to hit Chinese companies, and that would have a real domino impact because a lot of these companies have taken on a lot of debt from Chinese banks, and if they fail, then obviously they would fail to pay back that debt, and that could put pressure onto the whole banking sector. I recently posted a video about the shadow bank Zongzi, which is one of the largest bankruptcies that China has ever seen. That company currently has a black hole of around $64 billion on its balance sheet. And that will have a ripple impact because as that company goes down, it won't pay some of its liabilities. And so the companies that are owed money will then struggle because they won't have as much cash. And so you can see how it starts to impact on the wider economy. Now, many commentators were surprised that the Chinese authorities didn't step in to save Zongzi. And it will be fascinating to see what happens if we do see a lot of companies in China getting into financial difficulty as a result of the fact that they've cut their prices too far and are now making losses, and whether there is a wide-scale bailout scheme put in place to try to support all of these different companies, or if the Chinese authorities tell the Chinese banks to provide more debt facilities. But of course, that's just kicking the can further down the road, because the more debt you take on doesn't solve your problems if you're continuing to sell your products at a loss. So the overall summary of today's video is that at face value, the November figures look like positive news from China's perspective. However, when you dig down into the details, there are some real issues underlying these figures. And the takeaway from today's video is that a lot of companies in China look to be struggling to make a profit right now. And if that situation continues, we could see a massive increase in bankruptcies in China, which would have a hugely negative impact on the overall economy in 2024. So hopefully you've enjoyed today's video, you found it useful, informative and thought-provoking. If you've liked what I've said, then please give me a thumbs up. Thank you for watching this video all the way through to the end, and here's something to put a smile on your face.